This is part 2 in our Receivables and Accounting for Uncollectibles series, and in this part we're going to be discussing the allowance methods for accounting for uncollectible accounts. There are two methods under the allowance method, and the first one is called the percent of sales method. So we're going to be looking at an example here to get an idea of how to use this method. During its first year of operations, Signature Lamp Company earned revenue of $350,000 on account. Industry experience suggests that bad debts will amount to 2% of revenues. At December 31st, accounts receivables total $40,000. Journalize Signature's uncollectible account expense during using the percent of sales method and show how accounts receivable would be reported on the balance sheet at December 31st. So the first thing we have to do is calculate our uncollectible account expense. Because we're using a percent of sales method, we're going to take the percent that we do not believe we will collect, and this percent is gathered from doing industry research or from our past experiences. And here we've decided that 2% of revenues will not be collected, we believe. So we're going to take our sales of $350,000 during the year and multiply that times the 2%, and we get $7,000. So $7,000 of that $350,000 we do not believe we will collect. So we record this by debiting what's called uncollectible account expense for $7,000 and crediting the allowance for uncollectible accounts for $7,000. Now please keep in mind, at this point, no individual customer has been written off. We're only accounting for what we believe we will not collect. Therefore, following the matching principle. Matching expenses with the revenues those expenses created. So let's see how this would appear on the balance sheet. So we have our accounts receivable of $40,000. And remember, we now have a contra asset account, which is the companion account to accounts receivable, called the allowance for uncollectible accounts, and it reduces our accounts receivable, and that was $7,000. That gives us our net accounts receivable of $33,000. So what I want you to be aware of here is note that the percent of sales method adds to the balance in our allowance account. So keep that in mind. It adds to the balance in the allowance account. Now let's go through a whole process here. The accounts receivable balance for Turning Leaves Furniture Restoration at December 31st, 2010 was $15,000. During 2011, Turning Leaves completed the following transactions, and I want you to journalize each. The first one, sales revenue on account was $422,000, and I'm telling you to go ahead and ignore the cost of goods sold entry. But recall, when you make a sale, there are two entries. The first entry is to record the sale, either for cash or on account. And the second entry is to record the cost and reduce the inventory. Here, we're simply going to do the first entry, which is the sales. So it says that we made the sales on account. So we're going to debit our accounts receivable for the $422,000. And we're going to credit our sales revenue for the $422,000. The second transaction that would happen is collection on account. So we're collecting the sales we made, $422,000. So if we're collecting something, that means we're receiving the cash. So we would debit our cash for the $422,000. And we are no longer owed that money, so we would credit our accounts receivable for the $422,000. Now we're going to write off any uncollectibles, and we have decided that there are $6,000 worth of accounts that we are not going to collect. So we're specifically writing off particular clients or customers. that we think we will not collect from. So to do that, we're going to take that out of our allowance account with a debit. Remember, the allowance account carries a credit balance. So now we're writing them off, so we've finally deemed this particular customer or customers to never be collected. So we need to take them out of our allowance account. So we're going to debit the allowance for uncollectibles for that $6,000. And we also will write off their account receivable. So whatever the customer we've deemed to be uncollectible, that's a subsidiary ledger, which we talked about in the prior part to this series. So it would be the account receivable account to the specific customer that we are deeming to be uncollectible here. And in the last one, uncollectible account expense is 3% of sales revenue. So here we've got another year, and we're determining that 3% of our sales, and in the problem we saw our sales to be $422,000. So to calculate 3% being uncollectible, we would take our sales of $422,000 times 3%. That's telling us that our uncollectible account expense for the period would be $12,660. So to journalize that, we would debit our uncollectible account expense for the $12,660, and we would credit the allowance for uncollectible accounts, $12,660. That's the percent of sales method under the allowance method. The second way to account for uncollectible accounts under the allowance method, please note we're still under the allowance method, is called the aging of accounts receivables. Down at the bottom of the slide here, you've probably seen something like this on your bills you've received in the mail, whether your bill is 0 to 60 days, or if it's over 60 days due, etc. So let's look at Interstate Marble Importers. They have the following normal balances at December 31st, 2007, before the year-end adjustments. So we have a debit balance in our accounts receivable of $74,000, and the contra asset account, the allowance for uncollectible accounts, we have a credit balance of $2,000. And the aging schedule shows the following. So 0 to 60 days, our accounts receivables are $70,000. Over 60 days, we have $4,000 for total receivables of $74,000. We deem that 2% will be uncollectible if it's 0 to 60 days old. If it's more than 60 days old, 20% will not be collected. So we need to calculate what won't be collected, or what we anticipate will not be collected. So 2% of $70,000 is $1,400. 20% of $4,000 is $800. For a total uncollectible of $2,200. Now, one thing different from the percent of sales method and the aging of account receivable method, recall, percent of sales added to the balance in our allowance account. The aging of accounts receivable method gives us a new balance in our allowance account. So we have to adjust to that new balance. So the entry that we make will get us to this number, this $2,200, which is an adjustment, a credit of $200. So to journalize this, we would debit our uncollectible account expense for $200, and we credit our allowance for uncollectibles for $200. So again, just to review, there are two ways to account for uncollectibles under the allowance method. Percent of sales, which increases the balance in the allowance account, or changes the balance, changes the balance in the allowance account. The second method, or the second way under the allowance method, is the aging of accounts receivable. That gives us a new balance in the allowance account.